What's going on, you guys? My name is Hartley, and in this video we are going to talk about bonds. What are they, how do they work, and should you have them in your portfolio? I'm going to give you everything you need to know in order to make that decision for yourself. Here we go. Okay, so bonds. Bonds are really simple. It's basically when you go out into the market and you buy a bond, what you are doing is you are lending somebody your money. Now, while they hold that money, they're going to pay you interest payments, meaning you could get $5 per year back on the money that you lend somebody. And then at the end of a specific time period, they're going to give you that original amount back. So if you give somebody $1,000 in year one, and then they pay you $5 a year for 5 years, and then at the end of that, they give you your $1,000 back. That is exactly how a bond works. That's the basic principle. Now, there is a couple of definitions. So bonds are usually sold in units equal to about $1,000. That's kind of one unit is usually around $1,000. Now, the interest payments. So when you go out and you buy a bond, you're giving somebody else $1,000, and then they're going to send you interest payments. Those interest payments are called coupons. Now, I'm going to get into this in a minute why they're called coupons, but just keep that in mind. Now, the full payment at the end is called the principal. So if you give somebody $1,000, that is the principal amount, and at the end when you get that back, you're receiving the principal. Now, the date at which you receive that money back is called the expiration. So when you go out and you buy a bond for $1,000 and then you collect a $5 coupon every single year for 5 years, you will then get the principal amount back at the expiration date 5 years after you've originally given that money. So that's the idea and the definitions that we're going to use when we talk about bonds. Now let's get to that coupon topic real quick. So this photo here is a photo of an actual bond from 1898. This is really cool. This is what they actually looked like. And so this top piece here, this would represent the principal. So when you gave somebody $1,000, you would get this entire sheet back, and this large piece up here represented the $1,000. Each one of these little blocks at the bottom represented one coupon. And so the idea here was you would go to the market and you would buy a bond. You would get this sheet back, and then every year or every month, depending on how often you redeemed your coupons, you would take in one small little block of this right here. You would go to the bank or whoever you got the bond from. You would take that small little coupon, you would give it to them, and they would give you your interest payment. And then at the end of it, once you've given them all of the little coupons, you would go back in and you would take them this large block at the top, and this would be your principal payment, and that's how you get your $1,000 back. And so this is how bonds worked for a very, very long time, and this is the reason that we call them a coupon, and this is the reason that stores give out coupons today. So super cool little piece of history, and that's how the word coupon actually started. So that is what a bond used to look like. Everything nowadays is completely electronic and automated. So you go into the market, you buy a bond, you know exactly what the interest rate is and the expiry, and then you get your money basically automatically sent to you. So let's dive into that. So when we talk about bonds, there's 3 different types of bonds that you are going to want to know about. So the first one is T-bills or treasury bonds. These are federal government bonds where you are actually giving the federal government money, and then they are going to pay you interest. So really, really nice. And the great thing about this is it's super secure. The only way you're not going to get paid is if the federal government goes down and gets taken down and runs out of money. So this is the most secure financial asset you could actually own, is a T-bill, because it is backed by the actual Canadian government. It's more secure than your house. It's more secure than your bonds. It's more secure than anything else. This is the most secure financial asset that you can possibly own, is a T-bill or a GIC. Pretty much the exact same thing, is exactly this. So if you are looking for the ultimate level of safety, you are going to want a treasury bill. The second level down from that in the bond world is what we call munis. Now, these are basically municipal bonds that are held or given by the state or the city or the province, wherever you live, and they're basically smaller governments that are doing the exact same thing, except they are lending you out money. So when the city of Calgary wants to go and build a big road or a big construction project, they could sell municipal bonds to raise money for that, and I could go out and be an investor in that, and then the city of Calgary is going to pay me back over time and give me the principal back at the end. So that is an example of a municipal bond. And the third option is corporate bonds. It's the exact same thing again. However, the bonds are then held and use the money by corporations. So you go out and you give Tesla Motors $1,000. They give you a bond back and pay you an interest rate on that. So it goes in order just like this. So T-bills are the safest, munis are second, and then corporate bonds are a little bit riskier in terms of the bond world. However, all bonds are fairly safe depending on what kind of bonds you buy. Now, the one thing you're going to want to look at, and usually the most important thing, is the interest rate. This is the amount of money that you are going to get back in the coupon. This is how much money you're going to be able to generate from your bonds. So the interest rates here on bonds are fairly small. They are not substantial by any means. A T-bill, because it is so safe and it is so guaranteed, has a very, very small percentage rate of 0.08 to 1.42%, meaning you are not going to make a ton of money on a T-bill unless you are putting in millions and millions of dollars. Municipal bonds pay a slightly higher interest rate, up to about 2.04%, and corporate bonds you can find as high as 3.27%. Now, this is September 2020. These are the rates that are active right now. These rates do change over time, so if you're watching this video 6 months, a year from now, they may have changed slightly, but these are the general ranges that you will find in today's terms in 2020. Now, I know what you're thinking, Zach, these interest rates are super tiny, especially when you compare it to the inflation rate. You might actually be losing money, and the truth is that some years you may lose money. Inflation may be greater than the interest rate you are going to get a bond in some years, and the truth of the matter is it may be the exact same case for your stock or any other asset you own. So unfortunately, it's not a great argument, but yes, it does happen. It does exist. If you looked at the last 20 years, you can see our average is about 1.5 to 2% inflation. We haven't had any major spikes up like the 70s or the 50s in recent years. Not to say that it can't happen again though. So if you go out and you buy a long-term bond with only a 2% interest rate on it, well, you might be just breaking even on inflation at the end of the day. However, there are plenty of years where inflation is down to 0%, like what happened in 2008, 2009, 2010. There were certain years where interest rate was zero or sometimes even below zero, and therefore you're making even more money on your bonds. So it is definitely something to consider, but the reason people go into bonds is for safety, security, and cash flow, not to make an exorbitant amount of money, especially when compared to inflation. Okay, touching on that topic again, bonds are super low risk. That is the reason that people like them. That is the reason that people put their money into them. And that is the reason that the bond market is actually larger than the stock market in terms of total market cap. Now, people like this because a lot of people are in retirement. A lot of people manage money for pension funds, for retirement funds, and for long-term savings. And those type of people need low risk and steady cash flow. And that's why bonds work great for them. So T-bills are the safest, but they also have the lowest return. Corporate bonds have the highest return in comparison. However, if that corporation goes bankrupt or can't pay it back, you could take a loss on your bonds in comparison to a government that is much less likely to do that. Now, those are the only ways that you're really going to lose money on your bonds, or if the interest rate just skyrockets, it could be another issue for you. However, over the last 20, 30 years, that hasn't been a problem for anybody. Now, in summary, let's just cover the positives and the negatives of the bond. So when you go out and you buy a bond, it's really nice because it's super low risk and you have steady cash flow. You know exactly what your coupon rate's going to be. You know exactly what that cash payment is going to be every single month or every single year, and you can bank on it pretty steadily. It's also a safe store of money. So if you were just looking to store your cash, you don't need to invest it, you don't need to make a ton, you just don't want to lose your money, well, T-bills are probably the best place in the world for that because they're backed by the federal government, and the federal government is going to pay you to keep your money with them. They're even safer than a bank. So I do recommend that if you're looking to just store your money safely. The last thing is they are absolutely phenomenal for retirement. If you can get to the point where you can live off your cash flow from safe bonds, you have basically made it. You've hit the heavens of investing, and you are all set and you're good to go because you have almost no risk. You have steady cash flow, and you know you're going to get your principal back at the expiration. So you have nailed it. You've hit the holy grail of investing, and you've done it. Now, the negative side of bonds, and this is the kryptonite, this is why not everybody's in bonds, it's because they have a low return. If you're only generating 1 to 3 or 4% returns, it is not substantial, it is not great, and you can get better returns different places in the market, such as stocks, such as real estate, and such as other different financial options. However, none of them will be as safe as bonds, and that is the reason that people go with bonds. So those are the different things that you need to consider when you're managing your portfolio and you're deciding, should I buy bonds, should I buy stocks? Well, bonds are a great option, and one rule of thumb that a lot of people use is depending on what your age is, that is the percentage of your portfolio that should be in bonds. So if you're 90 years old, you should have 90% of your portfolio in bonds. If you're 20 years old, you should have 20% in bonds. Now, that is a rule of thumb that other people use. I don't personally stick to that because I'm actively trading. However, if you are just passively trading and looking to grow with a little bit of savings, that is the way to do it. That is definitely the way to do it. Put some money in bonds, keep it safe, bring in the cash flow, reinvest it into more bonds or dividend paying stocks, and grow your account that way. So if you guys got any value out of this video, please consider liking and subscribing. My only goal here is to help you make more money by providing you with free content to improve your trading. So please consider hitting that like button, hit that subscribe button, and I will see you guys in the next video.